All right. Good morning, good afternoon. Hello, everyone, and welcome to today's session, Tax Credits and IRA. Next slide, please. As I stated previously, we will be utilizing Poll Everywhere to track participation for CPE credit. From your laptop or your mobile device, please navigate to pollev.com/2022 IRA. I personally recommend using your mobile device. It's easier and faster. Again, pollev.com/2022 IRA. Please introduce yourself. It will ask you to enter your full name when prompted. Do not skip this step, please. It will then again ask you to complete 3 fields, your first name, your last name, and email, and click submit. Please keep the Poll Everywhere window open. You will need it throughout the entire training. Next slide, please. Great. KPMG is approved by NASBA to deliver CPE-worthy training. In order to receive CPE credit, you must attend for the entire session. You must complete both the check-in and check-out in Poll Everywhere. Right now, you are checking in. Please stay on for the entire hour and check out at the end as well. You also must participate in all polling questions. CPE eligibility is based on both time in the session and responses to polling. Participation is tracked, and failure to actively participate will result in denial of CPE credits. Due to only having an hour, we please encourage you to keep yourself on mute as well as keeping your camera off so connectivity can stay faster. We do encourage questions in the chat feature, and if someone does not get to them today, someone will reach out to you in the future. All right, I'll hand it over to you, Mike.
Excellent. Thank you, Madeline. Good morning, everyone, and thank you for joining us today on another episode of our KPMG Coffee Chat series. My name is Michael Mahana. I'll be presenting and facilitating today's session related to the Inflation Reduction Act. I'm a partner in our Los Angeles tax practice. I'm specifically within the accounting methods and credit services team. And I'm going to be joined by 2 very highly esteemed colleagues of mine, Julie Chappell from our Washington National Tax Incentives and Credits team, and then Rishi Parikh, a managing director in our accounting methods and credits team as well, here based in Los Angeles. Well, we have a lot to talk about. We're all very excited to get going on this, but unfortunately, we do have a very short amount of time to get to everything. And so what we're going to do is try to best provide as much content as we can over the next hour and try and get as much of the content to be relevant to the different folks that are here on the call today, given all the different backgrounds and industries and companies that you're all working with here. And part of that is there are a wide range of topics and provisions that are encapsulated within the IRA. And so we won't be able to get to everything today in our chat, but we do have some very important objectives that we'll be focused on. We first and foremost want to provide a very quick high-level update on the Inflation Reduction Act and some of the recent guidance that's been issued here over the last couple of weeks. We'll talk through a few of the specific credits within the Act that appear to either be industry agnostic or at least creating the most buzz within our client base, and we seem to be receiving the most questions on or inquiries on. And then we'll talk through a few of the practical considerations and discussions that we are having with many of our clients at the moment, again, given some of the uncertainties that are still present within the Act and all the guidance that we're expecting here. And so with that said, before I turn it over to Julie to get started, I do want to add one last preface for our chat today. As I mentioned, there still is a significant amount of questions that are left unanswered at the moment regarding some of these provisions within the IRA. And specifically on some of the topics that we'll even get to covering today, such as transferability and direct pay. However, the expectation is that we will see an onslaught of guidance to be issued over the next few months by the IRS and the Treasury that will help us close some of the loops on some of these issues that we presently don't have much guidance on just yet. And so as we begin to build more critical mass with some of the guidance releases, we will continue to schedule periodic follow-up chats such as this one to focus in on some of those particular areas or take a deeper dive into some of the guidance that may be of most importance to our clients. And as always, please let us know if there are any specific topics which you would like to for us to create maybe a subsequent chat for, or take again a deeper dive into. We will absolutely appreciate that feedback and can try and customize and cater some of these chats to more align with what our clients are looking for out there with respect to the IRA. And as Madeline mentioned earlier, we have a lot of content to get through. We'll try, as the questions come in, to incorporate them into the presentation. If we do miss something, or if something doesn't end up getting answered here, we will absolutely get back to one of our team members here presenting on the call. So please feel free to continue to utilize that chat feature here as we proceed throughout the presentation. Okay. And now with that, I will turn things over to Julie to get it going here. Julie?
Yeah, no, thank you, Michael. I'm very excited to talk to everyone about the Inflation Reduction Act. So thanks for joining this morning. So you'll see on this slide, there are a host of extensions and modifications that were enacted within the Inflation Reduction Act. It was signed in August, became effective. It still seems like a lifetime ago, I think, to us that sort of practice in this space. But lots of extensions, modifications, and also a host of new credits as well. So we've picked out some of these to focus on in more depth later on, but want you to be aware kind of there is a wide variety of credits, both for transportation, manufacturing, and then all of the sort of existing, renewable energy tax credits that you're aware of, as well as new credits for hydrogen production and some new technologies. So we'll leave that there. So,
Julie,
yeah.
one theme just to make sure is being highlighted here too is that we want to make sure you understand some of these credits previously existed in other credit regimes and do have some fairly significant enhancements, but also some very important modifications, which we'll point out. And then there are a handful of these other credits that are new credits, probably previously did not exist, that are essentially new law here that we're all digesting as we continue to get guidance and as that guidance evolves. So just want to make sure that that's very clear that, again, some of these provisions did previously exist in some form or another, and we'll make sure to point out those particular changes as we go along here.
Yep, absolutely. I think we can go on to the next slide. So one of the new aspects of the Inflation Reduction Act, or there's some sort of new strings that are attached to be able to qualify for the highest credit rate. The most significant being the prevailing wage and apprenticeship requirements. So, in a nutshell, that kind of means that we have to be sure we're paying our laborers and that our contractors and subcontractors are also paying the laborers associated with these projects a prevailing wage. There is a transition or sort of grandfathering period to be aware of. And that is, projects that begin construction prior to 60 days after guidance is issued by the IRS or Treasury. We now know that date is January 29th of 2023, so it's approaching pretty quickly. So the transition rule provides that if you begin construction prior to that date, that January 29th date of 2023, then those projects are grandfathered in and don't have to meet the prevailing wage and apprenticeship requirements to be eligible for that highest credit rate. Otherwise, projects beginning construction after January 29th will have to satisfy the prevailing wage and apprenticeship requirements to be eligible for the highest credit rates that we'll talk about in a minute. There is a curing process, just in case you find out that a laborer was not paid a prevailing wage. There is a way to fix that without jeopardizing the entire credit. You can pay the difference in the wage plus a penalty and interest. But we'll maybe pop on to slide 8 just to talk about this notice that the IRS issued, which is one of the first pieces of guidance that we have gotten under the Inflation Reduction Act. So at the end of November, IRS and Treasury issued Notice 2022-61, which gave us some initial guidance on the prevailing wage and apprenticeship requirement, and importantly, gave us that January 29th date. So we now know when the window ends to be deemed to have met these requirements. It also confirmed what we thought, that the beginning of construction guidance that we know and is already out in existence for ITC PTC 45Q, that continues to apply for purposes of the beginning of construction, for purposes of the prevailing wage determination. So basically, if you have physical work of a significant nature, or you incur 5% of the total cost of the project, plus you have continuous efforts towards completion, then your project can be deemed to have begun construction on those dates. I think one of the most interesting pieces of information out of this notice was the record keeping requirement. So a lot of the questions I think that I've heard are not necessarily, we plan to pay a prevailing wage, right? But what do we have to do to show that we've paid a prevailing wage to be able to get the full credit rate? What's the compliance going to look like? So the notice did indicate that the record keeping requirements and that substantiation burden is going to fall on the taxpayer that is claiming the credit here. So that's something to really keep in mind and be mindful of. This is definitely going to add an additional compliance burden. There was no indication that you could rely on a certification from contractors or subcontractors, so it's something to be mindful of when you're negotiating contracts for these projects with your contractors. Something you might want to put some language in and around. And also, there's going to be need to be some monitoring of what their contractors and subcontractors are paying, because ultimately you're going to have the documentation to substantiate that this prevailing wage has been paid, and certain levels of certain apprenticeship hours and percentage of hours are performed by qualified apprentices. And all of that will ultimately need to probably be presented to the IRS on audit if your credit is chosen for an audit. So pretty big news here with this notice that was issued. There will be an additional notice and comment period. Full proposed regulations will be issued on these points at some point. So this was just the beginning of the guidance that's going to come out. But it was helpful. They also pointed everyone to that sam.gov website on the Department of Labor to figure out what the prevailing wage is, depending on the type of classification of labor, the locality, and then also if a prevailing wage is not available currently on that website, then there's a process to request that from the Department of Labor.
Julie, I just want to point out a couple things really quick. So the 60-day clock that we make reference to here, the safe harbor, if you will. So an interesting caveat or twist to that is that 60-day does not apply to the 48C credit, which is the advanced manufacturing investment credit. So that one, regardless of what the date is here for this notice, that 60-day safe harbor is likely will not apply there to that particular credit, if that is one of interest to folks here on the line today. I think the other thing you mentioned, the record keeping requirements, there are specific examples of things that they point out in the notice that are good things to start thinking about or keeping track of. Things like, who are these individuals that are working? What are their titles? How many hours are they working? What are the rates that they're being paid during the period of construction or subsequent to that? So they start actually putting in a few particular items to be aware of within that notice that a lot of our clients are starting to think about and really see whether they have that information readily available, and if not, to start really thinking about that part of their documentation process going forward on any of these projects.
Yep. So just want to jump back maybe one slide, and then we can talk about the adders. So, significant prevailing wage to be able to claim the highest credit rate. But above the highest credit rate, there are a couple of adders that are available for ITC and PTC. The domestic content adder, which adds 10% to your ITC, 10 percentage points, and then 10% to the PTC. So bumps up that credit rate, and that is available for projects constructed using 100% domestically sourced steel and iron, and then a certain percentage of domestically sourced manufactured products. That is 40% in 2023. And then additionally, for projects placed in service in energy communities, that's another 10 percentage points on top of your ITC, 10% on your PTC. So potentially getting up to a 50% ITC, which is very significant.
Yeah, and Mike and Julie, I know there's some credits that it may not apply to, right? Like for 45X, for example, there's no prevailing wage and apprenticeship requirement. So that's something to keep an eye on too, just making sure it actually applies in for the credit that you're looking at.
Yep, lots of nuances here, for sure. I think unless you guys have anything else to talk about, we can maybe talk about the monetization for a minute. And this was really a game changer, I think. One of the biggest aspects of IRA and Build Back Better Act, which we have been tracking for over a year. Almost all of the credits were direct pay eligible. And when I say direct pay, I mean refundable. And it's refundable through a mechanism because the amount of the credit is treated as a payment of tax. So to the extent that your credit amount exceeds your tax liability, then that amount is a refundable tax credit. That was narrowed down within IRA. So you'll see here that there are 3 tax credits that are direct pay by election available. So that's 45Q, the credit for carbon dioxide sequestration, the clean hydrogen production credit under 45V, and then the advanced manufacturing production credit, 45X. We'll talk about some of these in more depth here in a minute. And then additionally, there's sort of a whole bucket of tax exempt entities, states, political subdivisions that can claim direct pay for almost any of these credits. So that is also a new addition. And then on top of that, all the other credits got transferability. So instead of getting, a cash payment from the government for in excess of your tax liability, you're allowed to transfer or sell that tax credit to an unrelated third party. That has to be paid in cash. But then, the transferor gets that gross income as tax exempt gross income. And then the transferee, the buyer of the credit, reports that credit on its return, getting the advantage, the full value of the credit. And then the amount that the transferee pays is not a deductible expense at that point. It's important to note that the eligible credits can only be transferred once. But this has really created a whole host of questions, really getting a lot of talk. I know we can flip to the next slide, and this just sort of scratches the surface on all of the credits or all of the issues and questions that we've been hearing. I think maybe the first question that I always get is, what's the discount rate going to look like if I transfer my credit? And, I think my answer to that is, well, remains to be seen. This begins January 1, 2023, but if you have a very well documented credit, so the risk of recapture here is going to fall on the buyer of the credit. So in my mind, it makes it very important, if you want to have a reasonable discount rate on your credit and you're the seller, makes it really important to diligence your credit out and make all these adders, the prevailing wage. There are a lot of nuances here. So making sure all of the I's are dotted and T's are crossed, so you get the best discount rate possible. And then I think what we're hearing is, somewhere around the 5 to 10% range is probably a reasonable discount rate. And that may be, it may be a little on the high side initially, and then over time sort of narrow. But Rishi, Michael, what questions are you guys hearing?
Yeah, I'll tell you, at least from our end, Julie, and as a credits practitioner, if you will, this is pretty exciting stuff for us. We started seeing this refundability mechanism essentially as part of the CARES Act with the employee retention credit, and then now as we're starting to see it move into the Inflation Reduction Act. I'm cautiously optimistic that, hey, maybe this will start spilling over into some of the other credits that we assist our clients with and whatnot. But from that perspective, I think this is a really important dynamic, and we're starting to see a little bit of a shift from a credit regime perspective, which is great. And then the other thing for us, or at least for me, in looking at this, this is really starting to open up the door to a number of our clients that have historically not taken advantage of these sort of benefits and incentives. Like a lot of these credits that we're talking about, at least the ones that existed before, there were general business credits. You could carry them back for a year, you could carry them forward for 20 years, but a lot of times that taxability never comes to fruition. And so all those credits, all those incentives that you had built up sort of go by the wayside and don't end up being monetized. The fact that there's going to be different mechanisms to actually monetize these credits and start incentivizing these sort of expenditures to be undertaken by our clients, it's really creating a whole new dynamic. We're talking to a number of businesses that are saying, hey, look, I never thought about putting a charging station at my facility, but you know what, if we get 30% of it paid, even if it's not a direct pay mechanism for us, we can sell it and make at least a portion of it. Yeah, why not? It helps our employees out. It helps our ESG initiatives get optimized. It helps us give some value to the properties or whatnot. These are all things that we have historically not had these sort of discussions. So it's been pretty exciting to be able to talk to a number of folks about sort of the rethinking of sort of these capital expenditures that have historically not really been able to be monetized. So that's one. The other thing, the fact that we're talking to a number of colleges and universities and other government instrumentalities that, again, historically may have been incurring spend on these sort of initiatives, but never were able to get a portion of this funded or subsidized through some sort of federal program. That in itself, I think, is really going to be a big deal here for us coming in the next couple of years, is starting to be able to engage with a number of businesses, taxpayers, clients, tax exempts, not-for-profits, all those sort of businesses here that are going to actually be able to take advantage of these. So from that perspective, that's another one of those emerging themes that I'm seeing, is the interest from a much more broader client base and trying to discuss a number of these provisions. So that's been great for us.
Yeah, and to add to that, Mike, almost on the flip side, right? What I've been getting as well, I don't qualify for any of these credits. I'm not in the energy space, but I'm paying millions and millions of dollars of tax a year. Am I going to be able to talk to somebody that I can buy these credits from, even though I don't qualify? They can't utilize them on their tax return because they're in losses, and I can get, say, 90 cents on the dollar, right, for those credits, and then apply those to my taxes. So I think that's another general theme of this that is in place. And then I think also the transferability versus the monetization piece, or versus the direct pay of this, right? A lot of companies are like, well, what if I have to wait 6 months, 8 months for the direct pay? Maybe I can get that cash sooner by transferring it, right? I think that's yet to be seen in terms of what would be better, what would the process be, what the timing would look like. But I think these are all things that we've been talking to clients about and have been getting questions on.
Yeah, absolutely. And going back to my initial intro here about a lot of this potential guidance to come out, this is probably going to be a whole separate session in itself, is once we get some more feedback and guidance on the transferability requirements and the direct pay. There's probably going to be a lot of procedural and administrative type of processes that the government's going to be putting together here as far as how to actually work all these different provisions out. So stay tuned on that one. That's another big one here, I think, as far as a guidance that we're all highly anticipating coming out relatively soon.
Yeah, and maybe one more thing to mention that I probably should have mentioned on the last slide. It appears that the direct pay period, at least for the non-tax exempt, will be 5 years. So for 45Q, 45V, and 45X, it appears that direct pay will be available for 5 years. There has been some question about whether a new election can be made at the end of that 5 years, but the tax community seems to be settling on likely 1 5-year credit period allowed for direct pay. After that, still available to transfer.
Very good. All right. We'll go to our first polling question, and hopefully none of these are trick questions. Should be easy for everyone, and we'll get them covered during the presentation. The first one is, has the IRS issued guidance on the prevailing wage and apprenticeship requirements, which establishes the 60-day safe harbor period? Yes or no? We'll take a minute there. Okay. Hopefully responses are coming in. Madeline, should we wait a minute, or we all good?
Let's just wait about 20 more seconds,
Okay.
and you can move on, and I'll keep it open for anyone that's thinking about it.
Perfect. So I shouldn't give the answer away yet.
Not yet.
Okay.
I think it's safe to move on, but I'll keep the question open.
All right. And of course, the answer is yes. Going back to Julie's discussion earlier about the January date that's been set as part of the notice that was recently issued here. And remember that this safe harbor period, again, applies to specific credits, 48C being one of those credits that this safe harbor period is not relevant. Okay. So we'll move into the investment tax credit. And one of the more significant and industry agnostic credits that's included in the IRA is this particular credit, is the ITC. This is one of those credits that has been around historically, but of course the new law extends and modifies the ITC in a number of different ways. For all of the qualified energy property eligible for the extended ITC, the new law creates this multi-tiered credit structure that consists of a base credit and then this bonus credit rate. So going back again to some of the things that Julie was mentioning, in this case here, the base credit will be 6% for the qualified energy property. Microturbines are going to be 2%. That is one exception. And then alternatively, the bonus credit can be at 30%, right, of the basis of that energy property, to 10% for the microturbines. So long as you, again, qualify or satisfy the prevailing wage and apprenticeship requirements. So, which can be further increased, as we found out, through the new domestic content or the energy community requirements being satisfied. But as you can see, some of these additional provisions added into the IRA, if not met, can have a very significant impact on the rate of the credit and ultimately the realization of this benefit. And so, looking at a significant solar investment of $1 million, it could be a 6% credit versus a 30% credit. That can make a pretty huge impact to a business, at least from a modeling perspective. So some of our clients are looking at this and are building into their expectations that the 30% rate is where they're going to be, at a minimum. Forget the domestic content and the energy community provisions. But if not, again, you sort of default to this 6%, which is a significant drop there. A quick note that the new ITC credit rates are generally going to apply to projects that are placed in service after 2021. With the exception of some of these new technologies that have been added to the eligible property listing. So in addition to the eligible property that is very common, the solar, the combined heat and power, and some of the others that you see here on the screen, a significant addition, or at least one of the major ones that we keep getting a number of inquiries on, is the addition to the ITC eligible property of energy storage property, right? This seems to have been a fairly long-awaited addition. And again, we're seeing a number of our clients either beginning to invest or planning to invest in this sort of energy property, especially as this technology continues to evolve and become much more efficient in the retention of power, we're starting to see a lot more investment in that space. So that was a really important addition, I think, to this. These particular rules here is the inclusion of this energy storage property. And specifically, one of the bigger things we're seeing is where you have a solar, for example, CapEx project, and you're trying to optimize the production of that solar energy, it's being accompanied by this advanced energy storage systems that can basically retain some of that power that's being produced off the solar panels. A lot of that integration is also something that we tend to find a lot of, or seeing a lot more prevalent here within the space. And really industry agnostic, quite frankly. I mean, we're seeing them put on commercial buildings. We're seeing them put on corporate buildings. We're seeing them put on college campuses in sort of a microgrid environment. So there seems to be a lot of dollars that are either projected to be spent or currently being spent on this sort of technology. So this credit with respect to this property is fairly significant. I think one other specific timing consideration I'd like to point out here with the ITC is that there is a beginning of this construction date that may creep up quickly. Specifically, the beginning of construction date, not the place in service date, must take place before 2025 to be eligible for this version of the ITC. For all projects that begin construction after 2024, there will be a shift in the ITC regime to a more emissions-based investment credit, and that's going to be under sections 48E and 45Y, which is sort of the new production tax credit regime there. So those credits are all going to be something we'll obviously take a deeper dive in at a later date. But I did want to point out that particular important consideration here. I know just earlier this week I was on a call with a client. And they're like, I can't believe that the construction date is literally 2-3 years away. I mean, it's creeping up very quickly. And a lot of these big projects, they may be in design and preliminary engineering and feasibility studies for quite a long time before shovels are actually in the ground. And so because of the validation of those beginning of construction rules that were part of that prevailing wage notice, I would highly recommend starting to look at those timelines and those plans if there is projects under this particular regime or this particular property that you'll be undertaking to take into account those particular provisions. Last thing I'll point out here is that this is one of those credits that is only eligible for direct pay for governmental entities and instrumentalities, but is transferable to all other taxpayers. Rishi, Julie, anything to add on that one?
Yeah, maybe to add on one thing. So note there that geothermal and combined heat and power got increased rates. So previously those were part of the 10% ITC, but they were bumped up to the full 30% ITC on the bonus rate. Combined heat and power might be one that is important to begin construction prior to the end of 2024, if it's not going to be emissions neutral after that point in time.
Yeah, one other thing to add, Mike, too, I think just common theme across all these credits is like these credits are based on like the basis of property, or some of the production credits are based on production costs, right? So as you get into this in detail, there might be a lot, we're seeing a lot of clients are asking about planning ideas, like how do I maximize the basis? How do I maximize the amount of production costs in future years? And so there's accounting methods, planning ideas, there's basis increase, but there's a lot of things there that could be done. So I would say, look at the basis of those assets as you get into it, try to get out ahead of what's actually going to be capitalized and sitting on your books for those. So I think that's another area that we're seeing get a lot of attention.
Yeah, that's a great point, Rishi. Thank you. Very good. All right, we'll move on to a second polling question here. I'll pop that up. Do the IRA provisions make governmental instrumentalities eligible for direct pay? Yes or no? We'll take a minute there before we move on here to credits for carbon sequestration investment. And Madeline, same thing, if you don't mind, just giving us a heads up when we are ready to move on.
Yeah, we have a little bit more than half, so maybe about 20 more seconds.
Perfect. Okay. And again, the answer here is yes. Of course, there could be exceptions or certain facts that would need to be evolved, but generally speaking, as we mentioned earlier, that this is going to be a very, very important addition to this particular credit regime here is the inclusion of these sort of governmental entities, not-for-profit, tax-exempt type entities. So, okay. Julie, we'll move on to credit for carbon sequestration here.
Yep, sounds good. So prior to joining KPMG, I was with the government and was a primary author of the 45Q regulations. So, you know, I enjoy talking about this one. You'll see the same sort of base and bonus credit regime that Michael just talked about with the ITC. That's sort of a theme throughout most of these credits. But 45Q, again, an existing tax credit. It was actually created in or enacted in 2008, but has been significantly enhanced a couple of times. And here within the IRA, significant credit increases. So up to $85 per metric ton for carbon oxides that are captured and then sequestered in permanent geological sequestration. For EOR and utilization, it's a $60 per metric ton. So this is a 12-year credit period. So it can be a very lucrative credit over 12 years at those credit rates. Again, I guess to just sort of high level on 45Q, 45Q is different than like a ITC or a PTC, which is renewable electricity. 45Q takes an existing industrial facility or any type of facility that emits carbon oxide emissions, and that includes carbon dioxide or carbon monoxide, and then it captures those emissions and then securely stores them, so that they don't get into the atmosphere. And you can store it either through that permanent geological sequestration. You can inject the CO2 into EOR, which is enhanced oil recovery, or you can utilize the CO2 in a commercial product or process. There's also direct air capture, which got huge credit rate increases as well. This is one of the refundable tax credits, which is made by an election. You have to make that election with respect to each particular carbon capture equipment or facility that's placed in service, and then that direct pay is eligible for 5 years. There are minimum capture thresholds, but helpfully the IRA reduced those thresholds. So now the general bucket is that other industrial facilities and only have to capture 12,500 metric tons of carbon oxide annually to be eligible for the 45Q credit. So you guys hearing anything on 45Q? I mean, I definitely think it is a hot topic, but there's certainly some, logistical challenges where you have to sort of line up all of the chain as far as the capture equipment and being able to then store the emissions. So kind of lots of those pieces are still in development, but it's definitely a hot topic.
Yeah, Julie, I do have a question for you. Is there any specific industry that you're seeing this apply to more than others, or is it fairly widespread application here? Do you have any intel or insight into that as far as who's really considering or looking at this credit? Is it mostly manufacturing and those sort of types of operations?
I think, initially it is more the energy industry.
Yeah.
It's a little bit easier, I think, for them more in their wheelhouse on the storage side of things to figure it out. But definitely more and more manufacturers looking at this. We're starting to see the idea of hubs, spring up. And so the hub idea takes, a manufacturer or the emitters, right? Or it can be in any kind of emitting facility. And then, it pairs it together with the midstream and the storage pieces of the value chain. So then you have all of those companies participating in that hub. and it definitely decreases the cost of, per metric ton of the storage of that CO2. But there's also been, a wide variety on the utilization. For example, you can take captured carbon dioxide and use it in the creation of concrete aggregate or building materials, dry ice, soda bottling, fertilizer, things like that, where you're using the captured carbon dioxide and putting it into some type of commercial product or process. So that's pretty industry agnostic, I would say.
Yeah, very good. Appreciate that. Thank you. Okay. Anything else on that one, Julie?
No, I think that's the basics.
Great. Thank you. All right, Rishi, you're up here. Moving on to the 48C credit.
Yeah. So there's two credits that we're going to hit on today. There's the 48C, which is a production tax credit, and there's also the advanced manufacturing tax credit that we'll hit on next. So the 48C credit is the advanced energy project credit. It's fully transferable, as Julie talked about before. So, and this is the new version, new and updated version of this credit. There was an older funding cycle back over a decade ago that was out there. So this may look familiar to a lot of you. So there was $10 billion that was authorized in credits for qualified manufacturing facilities. There's a limitation in that $4 billion that has to be invested to brownfield site and communities formerly relying on fossil fuel industries like coal, oil, natural gas. They did leave a number of open-ended items here to make decisions by the secretary that we're still waiting on. In terms of what qualifies in the qualified manufacturing facility, there was a whole list of items like fuel cells, microturbines, property that produces energy from wind, solar, geothermal. But then this legislation actually expanded the qualified manufacturing facility definition to include any energy storage system, fuel vehicle cells, hybrid vehicles, and then there's a couple other items in there that are worth looking at. And so the list is larger than it was previously, which is a good sign for a number of taxpayers. The key thing with this is that it's not like the other credits where you just go file it with your tax return. There's a very specific certification process, and that's required. And so what the guidance says and the statute says is 180 days from when the Inflation Reduction Act was issued, the government is required to issue the application process or really guidance around the next steps. So that timing should look like around February. I think by the end of February is the time frame that we're expecting to get that guidance. Previously, the application process was that there was certain criteria that the government would look at, and they had a point system that was applied to each of the taxpayers. And some of the criteria that they would look at is there a reasonable expectation of commercial viability, greatest job creation, shortest time from certification to completion, right? So what would happen is you'd submit this application probably starting in February. There's going to be a very short window period, at least there was before, maybe a few months. Julie, you can keep me honest there, but a very short window period. Get the application in, and then you wait to hear back via that point system. And then what you'd have to do is you submit that to the Department of Energy. If you do get the funding, then you have to go through the entire IRS certification process to make sure it's documented and you're reporting that correctly to the IRS. And so I think there's still a lot to be determined there when that application comes out. But I think for anybody that's considering this or thinks they're going to qualify for it, I'd be ready to go by February to hit the ground running when this comes out, because I don't think you're going to have a lot of time to go after it. The one question we do get, and I'll hit on a little bit when we get to the next credit, but can you take both the 45X and the 48C, because there's a lot of overlap on it? And the short answer is you can't take it on the same facility. And I think the definition of facility maybe still remains to be seen as to, is it the entire building? Is it part of the building? Is it part of the facility? Is it whatever it may be? So I think that's something we're still waiting to hear about. But Mike, Julie, your thoughts? Is there anything else that I missed or that you've seen that we should add here?
Yeah, I'll just reiterate the safe harbor period not being applicable here. And part of the reason, this is just my speculation, is that because of this application process, that's probably why logically that was not included. But Again, that's important. I think the other thing that we keep reiterating here as well is that there is a limited amount of dollars here applicable for this credit, right? I think it's the $10 billion limitation there that's going to be apportioned. And so what we saw back, I think it was in 2009, is a number of our clients actually did submit applications with X amount of credit being requested. And even though they did receive credit, they did not receive the amount that they were actually initially submitting as part of their application base. So those are some things that I think just cautious historical knowledge of this particular program. And leading into the next credit here, Rishi, one of the things that we're starting to see a lot of our clients doing is sort of modeling out the differences between the two credits to see sort of which. And I'm sorry if you were going to get to this, Rishi, but we are seeing some modeling taking place to see, okay, does that one-time investment into this 48C project, is that going to yield a better benefit for us than looking at this production credit that may have a longer tail behind it as far as recouping benefit on that productivity aspect of it? So those are all things, I guess, practically, again, looking into. As far as the application goes, a lot of our clients are really just starting to aggregate a lot of the facts here based on the provisions that are out there, and starting sort of working out a template as to what the application may look like, again, based on historical knowledge. But again, this February date is really something we're all looking to, and it is a statutory date, right? So for all intents and purposes, that is going to be the cutoff there as far as getting guidance, further guidance on this particular provision.
Yeah, and maybe one other thing to just sort of add on. So, I mean, 48 Cap C is sort of a traditional manufacturer's type credit, but it was expanded and broadened, and you'll see here a couple of the things that were added. I mean, number one, re-equipping an existing facility with equipment designed to reduce greenhouse gas emissions by at least 20%. So that's also eligible. You don't have to manufacture anything for that. And then, expanding or establishing a facility for processing, refining, or recycling of critical minerals. So just to highlight that this is a pretty broad credit.
Yeah, very good. Thank you. Okay.
Right, look to the
go on to
45.
the next one, Reese. Perfect. Yep. So this is the 45X credit. So this is the production side of the advanced manufacturing.
Yep. So this is another credit that was introduced by the Inflation Reduction Act. And the good thing about this one, it has the direct pay or the transferability option. So this is probably one of the most flexible credits. And this is a credit that's based on production costs for certain eligible components of wind, solar, battery. And there's also a critical minerals piece to this too. And it's for components that are produced by the taxpayer and then sold to unrelated parties. And so it's available for components produced and sold after 2022. As I mentioned, it's a percentage of production costs, and depending on the eligible component that's in place, there's a certain percentage that is required to be applied. So when you go to the statute, you could see that, for example, critical minerals is generally 10%, but there's some fluctuating percentages. This one does not have the prevailing wage and apprenticeship requirements. And so I think that makes it easier to qualify for the actual amounts that are listed. So you're not going to have that big swing, if you don't meet those requirements. As I mentioned, you can't claim it on the same facility as 48C. It is phased out over time, except for the critical minerals piece of this. And on the critical minerals, there's a specific list of minerals that are listed in the statute. You'd have to go look at and make sure that you fall into that bucket to qualify. What we're getting a lot of questions on around this, because when you look at the calculation, it's a percentage of production costs, right? So do I just take my production costs and apply percentages and I'm good to go? And I think the main thing that we've had conversations on is, what is the definition of production costs, right? And so a lot of that is around, well, do we assume that it's under the normal 263 Cap A production cost rules that are out there that have been out there for a number of times, based on UNICAP, or is there something that's going to be more broad released by the IRS? Is it going to be more narrow? And so I think that's something that we're waiting to be seen. I mean, if you assume the production cost rules line up with 263 Cap A, there's a lot of planning that can be done now to help increase your production costs in 2023, that's worth considering from a method change perspective, or a couple other elections and items that can be made to help increase those production costs. So I think that's something to keep in mind, because there's things you can be doing on this coming return, even though you may have to wait till 2023 to start claiming this. Julia, Mike, any additional thoughts on that one?
Yeah, we didn't put the list of all the components and critical minerals here on these slides, just because it would take up a number of pages. But to your point, Rishi, and we have a real life example of this where one of our clients actually went down the list of provisions and said, wow, we actually do produce this and we never lobbied for this. And now all of a sudden we might have this really significant benefit that we need to really take into account. So for anyone within the production manufacturing industry environment here, if there's even some sort of potential applicability, we would highly recommend just going to those provisions, and we can send a list of them after this call as well, just for your reference. But take a look at that listing, and maybe it's an anomaly, but we've seen it happen a few times here, where again some of our clients have been pleasantly surprised at what they're actually producing is on that list, and all of a sudden opens up the door here for another opportunity. And part of that modeling that we're talking about with this 45X, with the refundability aspect of it, that's a huge deal, right? So in terms of debating or deliberating between the two separate provisions, I think that is a big game changer here with this evaluation as well.
Yeah, and along the lines that Rishi mentioned, a big question around what's considered production costs. And another question I've sort of heard is, who's the producer? A lot of times there's a scenario where there's a contract manufacturer somewhere involved, and making the determination about who's really entitled to this credit as the producer of the component is also important.
Yeah, great point, Julie. I mean, again, you can see it, how many, the more you brainstorm, the more you think about all the different fact patterns, that there's a lot of different scenarios here that we're contemplating, that hopefully at least some of this pending guidance will help us draw to some conclusions on things like that. So very good. All right, Rishi, anything else here? I know we're getting close on time.
No, I think we're good, Mike.
Okay, let's go to our third polling question. And that is, what is the ITC base for the following technologies? Solar, small wind, waste energy recovery, offshore wind, fuel cell, geothermal, combined heat and power, energy storage, biogas, and microgrid controllers. Is it A, 6%, B, 30%, or C, 55%? And again, remember the base rate here that we're talking about. Give that a couple minutes here, or a minute.
Yeah, we have more than half have answered.
Okay.
So for the sake of time, if you want to move on, I will keep the polling question opened. I'm sorry.
All right, very, very good. Thank you. So the last topic of discussion here again is going to be on something that we believe might be more industry agnostic as far as potential applicability. It's going to be the vehicles and the charging stations. So again, there are a few credits here and provisions, including the IRA, related to this sort of investment. Some of these are, again, predecessor credits that existed before. There's some that are new here. But let me start with the 30C credit, which is the alternative fuel refueling property credit, which better known as charging stations. This is another one of those credits, again, included in the IRA, which previously existed prior to the enactment of this new law. But it features some relatively significant changes and enhancements. Specifically, under the prior law, taxpayers were eligible for a 30% credit for the cost of the charging station, capped at $30,000 per location per year for business taxpayers. There was a different limitation for individuals, but from a business perspective, you did have that $30,000 cap. It was a per location per year limitation that was in place. The new law makes some major changes here. The first is that the $30,000 limit per location has been replaced with a $100,000 limitation, and it's a per item limitation now, as opposed to the per location limit. Of course, this all sounds too good to be true, and yes, there's a catch. First off, the catch is that, or first off, the credit is still 30%, but only if the taxpayer satisfies those prevailing wage and apprenticeship requirements, or else it defaults back to the 6%. So that's one major difference there. The other is the addition to the new law, which is catching a number of our clients off guard, is the requirement that the property actually must be located in an eligible census tract to be eligible for the credit. Whereas the prior credit regime, regardless of the location, that did not have any bearing on eligibility. Whereas here, it must be within this quote unquote eligible census tract. And what is a census tract? It's generally low-income communities for purposes of the new markets credit, or a location that is not in a quote-unquote urban area. And there are some additional pieces of guidance out there to try and identify where those census tracts actually are located. But that is an interesting twist here, which is again catching a number of our clients off guard, is the specific location requirement to be eligible for this credit. And then lastly, the new law does extend the expiration date for this credit to property placed in service prior to 2023. And then again, similar to the ITCs discussed earlier, the credit is only allowable as direct pay to a governmental tax exempt
Por favor,
entities.
señora, siéntate aquí.
Uh-oh. And the rest will be transferable, right, for other taxpayers. Given we have 2 minutes and one more polling question, just a quick update. We'll send out the slide deck here just so everyone has this, but there is a commercial clean vehicle credit that's in place now under the 45W regime. And then you also have the modification to the 30D credit, which is the purchase of electric cars. And the big difference here, the big note to make for the 30D credit is that this also creates a sort of two-tiered structure for the credit, depending on a few other requirements, one being final assembly of those particular vehicles. It has to do with some of the components that are going in, as to what percentage of that component is actually assembled or manufactured within the US. So those are all things that are changing as part of this particular credit that I think are worth noting. And then again, with the 45W, this is a new credit. This previously did not exist. But it does not include all those particular additional requirements to be met in order to satisfy the maximum credit. This did not have those assembly, battery components, and critical mineral requirements there. So anyhow, that's where we're at. We'll get to the last polling question here really quick, just before we let everyone go. And while this is up on the screen, again, I just want to offer again my thanks for joining us today. And hopefully we covered at least a portion of the topics that are relevant and important to everyone out there. And as we mentioned at the beginning, we'll take note of some of the questions that did come in, and we'll reach back out to you. And please keep an eye out for subsequent presentations on the Inflation Reduction Act. We might focus specifically on industry. So if there's a specific industry that seems to get a lot of attention here and would like a deeper dive from an industry-related perspective, we'll go ahead and do that. And of course, as new guidance evolves and as information does continue to come out, we'll try and do some of these periodically here. But your feedback is always appreciated. And again, thank you for your time and thank you for your attendance. Hope everyone has a good rest of the week. And then happy holidays to everyone if we don't get to see you again before then. Take care.